I'm interested in comparing the move to the VIX. I sort of use it as a three-part sandwich. The first layer, what your index captures, implied volatility on treasuries, risk-free
Right.
securities, credit risk-free, not interest rate risk-free. And then at the top of the layer is equities, which is sort of the sexy stuff that gets all the attention. Huge drawdowns in individual names, Roku, Carvana, whatever. But as you say correctly, in the index itself, the way it's constructed, we haven't had a lot of 4% down days. And as such, the VIX, it hasn't gone much higher than 35. I want to know, what do you think about the thing in between, which is credit vol? So it's a move, when you say it's the VIX for bonds, VIX for risk-free bonds, treasuries. It's not for credit, not for liquid LQD, HYG, or let alone mortgage-backed securities. So, what do you think about that stuff in the stuff in the middle between equities and treasuries?
Okay. When you look at, um, call it bond risk, okay, interest rate risk, um, what you see is, and let me make it a little wider, all risk for financial assets. There's three components. There's three possible risks. One is duration risk. That's measured by the yield curve, and that's when will I get my money back? They usually have a steep curve because you know what's happening in 2 years, you don't know in 30 years. So usually you demand a higher premium for that, and that's duration risk. And the steeper the curve, that means the more concerned we are about risk in the future, and we demand a higher premium. Now, the reason the curve's flattening here is the market seems to think, I'll use the word seems, that we're going into a recession next year, and thus the risk of higher rates is greatly diminished because recessions tend to bring slower economy, less demand for money, lower inflation, blah, 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 blah. Second risk is credit. Credit is, will I get my money back, right? Will I get it back? Will the company pay me or will it default? The third risk is how I get it back. That's convexity. So if you buy a 10-year treasury and you buy it at 100 and that bond goes to 110 and then 95 and then 105 a year from now, well, at the end of the year, you've made 5 points. That was it. Didn't matter how it got there. You buy, IBM 100 over the curve. It widens to 110 and comes to 90 and then goes to 105. You've made 5 basis points of spread tightening. Didn't matter how it got there. An option, a convex instrument, it depends how you get there. It is called path-dependent risk. This is a whole different animal. This is why, in general, people are really not very good at managing convexity or options because the human mind is just not great at processing a path-dependent activity of how you get there that matters as opposed to the destination. We're very good at saying, here I am, I know where I'll be tomorrow. Okay, we're not good at how we get there, and that's the third risk. And if you implied volatility, kind of is the price of that. If you had some super algorithm, which lots of hedge funds do, they'd look at all three risks and say which one has the highest expected possible return. Okay, and it'll then move money amongst those three different risks as appropriate, as they feel they should. So if one of the risks goes from giving you $10 to giving you $5, I'm making up numbers here, the other two are still giving you $10 of profit, you're going to sell the $5 profit instrument and move your money to the other two and drive them down to $5 of profit. And that's what you see happen. So if you were to go and graph the VIX, the move, high yield bond spreads, the yield curve, all of those, they go like this over time. Can you trade one versus the other? Please don't. You will lose. You will go bankrupt. They don't do that. You gotta, this is a 30,000 foot idea, and the lag time could be months before they catch up. And the beta could be small or large. But if you go map all the yield curve versus vol, it's a relatively tight correlation. Same thing with credit. And so you've seen the move go up, but you haven't seen the VIX go up. And that's why credit has not really gone up as much as one might expect. So if you put a chart of the move versus credit, it looks like the move's leading and credit's lagging, but the VIX has lagged even more. on a relative basis. So that's what's going on over there with those three things. Now, can you actually really map all three of those vectors? Kinda, but they mix with each other. So it's tough. But that's kind of the 30,000-foot answer you're looking for, as they're all correlated. And yes, indeed, it is kind of surprising we have not seen credit widened by more, especially high yield credit. And my partner Michael Green has detailed this whole concept of if we do get higher rates, and you see high yield debt, which is an average maturity of 5 years. If we stay in a situation where it's difficult to roll over that debt a year or two from now because rates are higher or we're in a recession, so banks don't want to lend, you could see a lot of companies go bankrupt. And so high yield is certainly at great risk right now, especially if rates go higher, which is why the Fed's probably worried about how far they're going to take rates.
Right. And some companies, not only do they owe high yield bonds, which mature in 2, 3, 4 years, they specifically owe loans, bank loans that are SOFR plus 2%. So it's baked into the cake. They're just going to have to pay more money. Harley, when you said if rates rise, I think you're talking about if the risk-free rates, the treasury rates rise.
Yeah.
But that is, so if people, if someone were to look at HYG year to date, it does have a drawdown. That is, historically, I think pretty substantial. But a great amount of that drawdown is in the risk-free component, not the actual widening of credit spreads themselves. Harley, I want to ask, if we have that capital stack, move, VIX, and credit is in the middle. So treasuries, equities, and then credit in the middle. Which does the Federal Reserve care about? Okay, Harley, you and I know that Carvana down 90%. The Federal Reserve is not going to bail out Carvana. Okay, we know that. And if the S&P is down 13%, 14%, that's the Federal Reserve is not pivoting now. Now maybe a 35%. Who knows? I want to get your take on that as well. But what about credit? I think it was really the freezing of the credit markets in 2008 that forced the Fed to act, and likewise in March 2020 when the Fed did an unprecedented monetary stimulus.